Hello, thanks for stopping by. My name is Ron. Welcome to the Entree Courier, where you are the boss. Hey folks, thanks for listening today. Welcome to today's episode, which is Understanding Taxes for Independent Contractor Delivery Drivers. You want to talk about taxes? Come on, it'll be fun, right? Okay, it's not fun, but it is kind of necessary. In fact, it's very necessary. Taxes can be the biggest pitfall you run into as a delivery driver, especially as you do so as an independent contractor. If you don't do your taxes, you can get in a lot of trouble. If you don't do them right, you get into a lot of trouble. So the purpose of this video is to help you avoid that a little bit by just understanding, at least to begin with, how taxes are different for those of us who are self-employed. See, when you deliver for Grubhub, Uber Eats, Doordash, Postmates, as a independent contractor side of Amazon Flex, and there are a whole bunch of others. When you do it as an independent contractor, you're not an employee. You're operating as your own business. And so what's going to happen is you're going to file taxes both as an individual and as a business at the same time. You need to understand that, and you need to understand what to expect so that you don't have problems when it comes to be tax time. Now, I've operated businesses both with employees, we've hired contractors. I've operated my own business as a self-employed independent contractor, and doing that now full-time as a delivery courier. So I thought that, okay, I've got some experience and some knowledge that hopefully I can try and convert into some plain language to help you understand so that you know what to expect. Now, this is important. You need to understand this. I am not a tax professional. This video is not meant to be tax advice. It's not meant to help you do your taxes, and it's not meant to be an in-depth description of the tax code. It's only meant to help you understand some basics about how taxes are different. And because there's no one-size-fits-all information out there. Just because taxes are complex enough, there are variations based on state, there's variations whether you're single, whether you're doing other work. So it's just impossible to have a one-size-fits-all explanation. But here's the deal though. I highly, highly, highly recommend you get a tax pro. Especially if you don't really know this tax stuff to begin with. And I don't mean by tax pro the guys that are setting up desks at the big box stores. A lot of those people, their training basically consists of they've been trained on their software, and that's it. You need an accountant. Go pay the money. I'm serious. I know it's more money. It's more money than you expect to want to pay. But if you get somebody that can look at your situation and who understands taxes, they're going to save you more than what you pay. So it is worth it. Go pay the money, okay? So let's talk just for a moment about kind of the basics of how you do taxes right now. You're probably used to using a 1040 or 1040A, maybe a 1040EZ, and you're going to have the following things on it. I mean, whatever type of form that you're using to file, it's got these things. It's got income, it's got your deductions, it's got your tax bill, it's got what you have paid in already, and and then it's got a line for whatever you either are going to get back as a refund or what you got to pay in. This stuff's pretty basic, so income is just what you made from your job. And it might be money from investments. It could be rental income, any kind of money coming in. And that includes self-employment income like you and I would get from doing our deliveries for all these different companies. The next item is your deductions, and those can be an itemized list of things like your mortgage interest, some healthcare costs, donations. You can have a long list of items. A lot of different things you can claim as deductions. If you don't have enough, what you can do is you can choose to go with a standard deduction. You can choose which one works better for you and whether or not you want to go to all the work of itemizing or listing. But this year standard deduction is $12,000 for a single person, $24,000 for a person, for people married filing joint. You then can subtract your deductions from your income, and that's where you get what's called your taxable income. Your tax then is based on your taxable income. How it's figured, it can be complicated, but it's not rocket science. It's not that hard to Google the IRS tax table. You take your taxable income. It's not your money you made ahead of time, but it's that money that's left over after the deductions. You take that taxable income, look it up in the tax table, and there's where your tax is. That's your tax bill. The next thing is you've got to put down what's already been paid in. So there are a couple things here. You've got money that's been withheld if you had an employer. You have payments that you made directly if you did quarterly payments. And I really recommend that you do that. And then you're also going to have in this area, this is where all your tax credits are. So things like, there's tuition tax credit, or there's an earned income credit, there's energy efficiency purchases. All of those things are basically treated like it's money that you've already paid in on your taxes. So all of that, you add all of that up, that's your total payments. And then you compare that to your tax bill. If your total payments and credits are more than your tax bill, you get a refund. If they're less, you owe the IRS money. It's pretty much about that simple. So anyway, once we've looked at how those taxes are, let's take a look at how things are different. Now, the first thing I'm going to do is look at one thing where taxes are sort of the same, and that is that you're still going to be filing, for the most part, on your 1040 form, maybe 1040A. In some rare cases, you might use the 1040EZ if you were part-time. The exception might be if you are incorporated in certain ways, but for most of us, that's not going to be the case. We're still going to be using the same forms. That's your main similarity. But there are some things that are very different. These are things that you need to know about. There's three major differences that you need to know. Number one, nobody is withholding money for you. Now, if you've worked as an employee, you've received your W-2 at the end of the year telling you how much money was taken out of your paycheck. If you look at your pay stub, you usually see things like your federal withholding. You might see state and local withholding depending on where you live. You'll see what's called FICA and Medicare. All of these things are money that are taken out before you get paid. They do this so that you don't get yourself in trouble and spend all of your money before your taxes are due. As an independent contractor, you do not get that. All of that is up to you. These companies aren't required to do so, and they'd really have a hard time figuring out how much to take out because all of your expenses would vary and everything. You're going to want to do that yourself. It's absolutely critical you do that yourself. We get into that a little bit later. Your second major difference is going to be that you report your earnings and your write-offs differently than you think you might. This is an area that actually often works in the favor of the driver because especially if you tend to take the standard deduction. There's a lot of mistaken beliefs around this area because a lot of people think that you just put in your 1099 income up in the income category just like you do with the W-2, and then you take your business expenses and your deductions. And I see people give the advice all the time that says, no, you cannot claim your business expenses if you take the standard deduction. Those people are wrong. They're very wrong. You absolutely can take your standard deduction and claim your business expenses, and that's because of the way that you report your income as a self-employed person. What you do instead is you're filling out a Schedule C to report both of your business income and your business expenses. And all of this is done as part of the income part of your tax return. Schedule C is called a profit and loss form for your business. There's an income section. That's where you put all of your 1099 information, as well as any other self-employment income. Now, like if you drove for Uber Eats, they do their 1099s kind of weird, so you may end up having some other income to put in because of them. What you're going to do then is you're going to enter all of your expenses then in the expense portion of Schedule C. So your car expenses, which is usually going to be your standard per mile rate. Your cell phone charges, maybe supplies like your cell phone holders, delivery bags. You're going to have your accounting fees. Any of your business expenses go in the expense part of the Schedule C. Then when you put it all together, what you do is you add up your income on the top, you add up your expenses on the bottom, and your income minus expenses is your profit, which you list at the bottom. When it's all said and done, it's your profit that goes into your income section. So the good news is you get to claim all of your business expenses, as that's all handled up here on the Schedule C in the income part. And then you just deal with whether you're using standard or itemized deductions on your personal stuff, just like you normally would. And for a lot of people, this is going to save a lot of money on your taxes. The third major tax difference when you're self-employed is that you have self-employment tax on top of your income tax. This is the big one that gets a lot of people into trouble because a lot of people, maybe even you, have never even heard of this tax. Why do we have this extra tax? Well, it's really not actually an extra tax. It's our version of Social Security or FICA and Medicare tax. You remember those from the pay stub days? Well, employees have 6.2% of wages taken out for Social Security and 1.45% for Medicare. Well, we're going back to difference number one. Nothing is withheld from our money that we get in. So that means that when we file our income tax, that's the time that we have to pay those taxes as well. And so our self-employment tax is 15.3% of our profits. Now, this is one of those good news, bad news areas, The good news is that from difference number two, we pay on the profits, not on all of the money coming in. So that's a good thing, right? But what about the bad news? Notice that the employees pay 6.2% plus 1.45. That doesn't add up to 15.3. Why are we paying double? See, your employer has to pay half of your Social Security and Medicare taxes. Now, this is why these gig companies don't want you as employees. They do not want to pay those taxes. Well, guess who gets to pay that other half then? You are your own employer, so that means you get to do it. That's why it's called self-employment tax, because we get to pay both halves of that tax, or 15.3%. But wait, there's more. And no, we're not talking about Ginsu knives here. We are used to our income tax being based on our taxable income, on what's left over after deductions. But with self-employment tax, it's just like our FICA and Medicare. Those are taxed on every single dollar you make. Now remember, that's on our profit. That's 15.3% on every dollar of profit. So you might have had $30,000 that you made in profits, $30,000 worth of deductions, so you don't have any income tax, but you still end up owing 15.3% on that whole $30,000 or $4,513. When you're a full-time driver, especially, that self-employment tax can be a huge hit. See, I don't know about you, but most of us don't have $4,000 lying around for a tax bill. Now, there is a little bit of good news in this. New tax reforms have allowed self-employed people to take deductions for up to a fifth of their self-employment profits, and they can deduct half of their self-employment tax. And even better, you don't have to itemize your deductions to claim those. You can get them even with a standard deduction. So this will help your income tax, but these deductions do not reduce that self-employment tax. As employees, you don't usually get into very much tax trouble because of the way that money is withheld from your checks. And when it does happen, it's more like hundreds of dollars as opposed to thousands or more. It's the business owner which includes you and I, who can get into real trouble, especially because of that self-employment tax, the Social Security, Medicare tax, all of that. So how do we avoid getting into trouble? Number one is to understand your own tax situation. Now, you never knew that when you got into all of this that you had to be a tax expert. You don't, but you do need to find one if you don't understand it yourself. Seriously, get somebody who understands self-employment tax. Go over your own personal situation, over whether any other income you've got, whether you have other income with a spouse, anything like that. Have them help you understand what you can expect as far as your own taxes. You need to understand how these taxes affect you, and whether that's by learning it yourself or getting help, and I strongly recommend getting the help. Number two, plan ahead and save. As you're getting that help, get a feel for what your taxes are going to be at the end of the year. I know that it's impossible to say what it's going to be because of the way that earnings fluctuate, but you can get a pretty good idea of how much you work, what kind of driving you do, what kind of expenses to expect, so you can get an estimate of what you think you're going to earn. Divide that up into a weekly amount. Take that money out every single week. Set it aside before you get a chance to touch it for anything. Treat it just like withholding. There's a reason they do the withholding, so that you don't get into trouble. Set it aside, and then once a quarter you pay in your estimated taxes. And as I've said before, get help if you needed to try and understand what you need to take out. Number three is keep immaculate records. Record everything you spend, every mile you drive. As part of you getting help with somebody, learn what kind of things you can record. Remember that you pay taxes on your profits. And so if you're not recording your expenses, you're paying tax on money that you don't have to pay taxes on. Every dollar you do not record is going to cost you 27 cents or more in taxes. Every mile you forget to record is going to cost you 16 cents or more in taxes that you don't have to pay. So keep excellent records. Now, all of this only scratches the surface. Like I said before, it was never meant to be in depth, but if nothing else, I hope you can take away how important taxes are and staying on top of them are as an independent contractor. And for gosh sakes, get a tax pro, not a tax preparer. Get somebody who understands how taxes work when you're self-employed, and they can help you stay out of trouble. Here's the deal. You are the boss. We love the flexibility and the freedom of not having to answer to a supervisor or any of those things, but there are responsibilities. You are responsible for looking out for your employee, who just happens to be you. So don't get your employee in tax trouble. Take care of business when it comes to taking care of your business. Thanks for visiting. For more advice on how to take control of your life and business as an independent contractor in the delivery world, visit www.entrecourier.com. Now go out and be the boss.